May 28, 2026 Real Estate News. High rates, sky-high rents, and surprising turns. Disclaimer: the following report is for informational purposes only. It is news analysis, not legal, financial, or medical advice, and these anecdotal stories should not be treated as any form of advice. Mortgage market freeze. High rates kick loan demand off a cliff. Mortgage lending activity has entered a virtual deep freeze as mortgage interest rates surge to their highest levels in months, dramatically pushing up borrowing costs and deterring both refinancers and buyers. Following weeks of rising bond yields driven by persistent inflation and a firm Federal Reserve stance, the average 30-year fixed mortgage rate has climbed back above 6.6%. Reaching its loftiest point since the late summer of 2025 and stunning market observers who had hoped for some relief by now. The immediate impact has been a sharp contraction in loan applications across the board. Refinancing applications have nosedived in response to the rate spike, with national refinance demand plummeting by roughly 18% in just 1 week, erasing activity as homeowners see little benefit in trading their older low-rate loans for new ones at today's elevated rates. Demand from home buyers has also pulled back, albeit less dramatically, as many prospective buyers hesitate, leaving overall mortgage applications down about 8.5% compared with the prior week. Industry data shows that purchase loan volume is only marginally above where it was 1 year ago, underscoring how higher rates have sapped much of the housing market's momentum. Lenders report that among those still in the market, buyers are gravitating towards smaller loan sizes and more affordable properties to cope with reduced purchasing power. And the average size of a new purchase mortgage has soared to a record high over $470,000, a sign that many lower-income or first-time buyers have been effectively priced out while wealthier buyers still proceed. The rise in borrowing costs has reshaped housing activity and left market participants recalibrating expectations, as analysts note that many homeowners with mortgages below 4% are effectively locked in and unlikely to sell or refinance, reducing housing supply and transaction volumes. By deterring move-up buyers and discretionary selling, high rates have helped create an inventory crunch where few existing homes are being listed for sale, further constraining options for buyers and supporting home prices in some regions even as overall demand softens. The Federal Reserve's aggressive interest rate policy to fight inflation has translated into mortgage rates stuck well above levels seen a few years ago, and officials have indicated that they do not foresee cutting benchmark rates in the immediate future, meaning mortgage rates may stay elevated longer than earlier anticipated. Bond market volatility and global economic jitters have added to the unpredictable rate environment, delivering frequent shocks to home financing conditions. Some relief was seen at the margins when calmer global news briefly eased Treasury yields, but any downward moves in rates have been slight and short-lived, keeping average mortgage costs near multi-decade highs. Economists now generally expect borrowing costs to remain in the high 6% range in the near term, which has left brokers and buyers bracing for a drier summer selling season compared to the frenzy of recent years. With fewer transactions going through and mortgage companies facing leaner pipelines, competition among lenders is increasing as they attempt to lure the dwindling pool of buyers and refinancers with slight discounts, temporary rate buydowns, and other incentives, highlighting the extraordinary steps being taken in an effort to keep the housing market moving in the face of this rate-induced chill. Would-be homebuyers and owners across the country are grappling with the affordability crunch, and new research underscores just how severe it has become. In a striking illustration, a recent report finds that the typical American household would need to earn nearly $120,000 per year, almost 50% above the current U.S. median income, to afford a median-priced home under today's financing conditions, a staggering gap that underscores why so many families are sidelined. Households are having to spend a far larger share of income on monthly payments than in prior decades, and in high-cost coastal markets the situation is even more extreme. Cities like San Francisco now require a six-figure salary many times over just to service an average mortgage. Real estate economists note that the leap in required income stemmed from both home prices that remain historically elevated and the steep run-up in mortgage rates, which together have far outpaced wage gains across much of the economy, effectively locking a huge segment of would-be buyers out of homeownership. This rapid erosion of affordability has drawn renewed attention from policymakers and industry leaders who fear a generation of young adults could be shut out of homeownership unless there is either a substantial drop in interest rates or new measures to boost attainable housing supply. Many prospective buyers who lack the necessary income are continuing to rent or doubling up with family, and the phrase "priced out" has become a painful reality for millions, reflecting a growing perception that the American dream of owning a home is increasingly slipping out of reach for those not at the top of the income scale. The affordability crisis, dramatically highlighted by these new findings, is reverberating through personal financial decisions and even broader economic patterns like migration. As some households relocate to lesser-cost regions in search of any path into the housing market. Insurance premium panic. Homeowners hit by skyrocketing costs. Homeowners across the country are reeling from the shock of rapidly escalating insurance bills, as home insurance premiums have soared in recent years to levels that are straining household budgets and causing widespread anxiety. A new national survey found that a large majority of U.S. homeowners, over 70%, have seen their homeowners' insurance costs climb in the past few years, including roughly 42% who reported that their annual premiums have jumped a lot, driving home just how pronounced the spike has been. These surges in insurance costs are being fueled by a convergence of factors: rising inflation in construction and repair costs, a series of costly natural disasters linked to climate change, and insurers reassessing risk in certain regions after unprecedented payouts from wildfires, hurricanes, and severe storms. The result is that many longtime homeowners, especially those on fixed incomes or in disaster-prone areas, are confronting insurance renewal notices with sticker shock, annual premiums doubling or even tripling in some cases. And some are forced to make tough choices between insuring their homes adequately and covering other living expenses amid the broader cost of living squeeze. For many, covering insurance has become as problematic as paying the mortgage itself. Industry experts explain that as weather-related losses mount year after year, insurers are recouping those costs by charging policyholders more and tightening underwriting standards, a trend that shows no sign of abating, raising alarms about a potential home insurance affordability crisis layered on top of the existing housing affordability challenge. The pattern of escalating insurance costs is particularly stark in regions with higher exposure to natural calamities, which have experienced the brunt of this insurance crunch. In states such as Florida, Louisiana, and California, where hurricanes, floods, and wildfires respectively have inflicted major damage, the insurance market has been thrown into upheaval. Multiple insurers have gone insolvent or pulled out of high-risk markets entirely after absorbing huge losses, leaving homeowners scrambling to find coverage at any price. Florida serves as a cautionary tale of this dynamic, with many homeowners being forced onto a state-backed insurer of last resort and facing annual bills that can be several times higher than what they paid just a few years ago. Some Floridians are seeing premiums climb to over $10,000 a year for modest homes, reflecting how insurers are pricing in the growing risk of catastrophic storms and litigation costs in that state. Those fortunate enough to secure coverage often must accept higher deductibles or more exclusions, effectively paying more for less protection, while others are resorting to cheaper bare-bones policies or foregoing optional coverages like flood insurance, which is financially risky but increasingly common as families struggle to catch up with these burdensome costs. The insurance industry points out that it too is under pressure, as it must remain solvent in the face of climate-driven megalosses and a surge in rebuilding costs, but consumer advocates and policymakers worry that without reforms or targeted relief, skyrocketing premiums could render some properties uninsurable, erode home values in high-risk areas, and lock prospective buyers out of those markets entirely. The relentless jump in home insurance costs has become a pressing topic in real estate and political circles, prompting calls for action and creative solutions. In some states, Legislatures are debating measures to stabilize the insurance market and provide relief to homeowners. Ideas such as hurricane catastrophe funds, state-subsidized reinsurance to lower insurer costs, or stricter controls on how quickly companies can raise rates are on the table. The issue has even seeped into broader housing policy discussions because exorbitant insurance bills effectively raise the cost of homeownership and can deter first-time buyers or those on the margins from purchasing a home at all. Meanwhile, financial advisors often counsel homeowners to resist the temptation to underinsure in response to climbing premiums, warning that doing so could be disastrous if a major loss occurs. Instead, some suggest shopping aggressively for better deals from competitors or bundling insurance products to eke out discounts, though these strategies offer only limited relief in an environment where virtually every insurer is hiking rates. The interplay of climate risk, insurance market constraints, and housing affordability is emerging as a complex challenge that could shape where and how Americans live. As one example, the prospect of unaffordable insurance is now a factor people consider when deciding whether to move to certain coastal or wildfire-zone regions. While immediate fixes are elusive, the fact that home insurance costs have suddenly become a front-and-center issue, capturing national headlines and stirring public frustration, suggests that more significant policy interventions may be looming if the market doesn't stabilize and provide relief to millions of embattled homeowners. In one especially hard-hit market, Florida, the home insurance crisis has escalated to the point of prompting sweeping political responses. After a series of devastating hurricanes drove several private insurers into bankruptcy and left others dramatically raising rates or exiting the state, Florida's government has been grappling with ways to keep homeowners insured without breaking their bank accounts. The state's insurer of last resort, Citizens Property Insurance, has ballooned in size as more Floridians have no choice but to rely on it, and even Citizens has implemented hefty premium hikes to try to remain solvent amid the flood of policies. Lawmakers have convened special sessions to address the turmoil. One high-profile proposal from the governor ambitiously aims to significantly increase the homestead property tax exemption, effectively cutting or eliminating property taxes for many primary residents as a partial offset to swelling insurance and housing costs. Critics argue that such tax cuts do nothing to solve the underlying insurance problem and could financially strain local governments, but supporters say bold relief is needed to keep homeownership within reach for middle-class families. The Florida situation, with average premiums multiplying and homeowners desperate for reforms, is being closely watched by other states because it encapsulates the dangerous feedback loop of climate disasters and insurance retreat. For Floridians, each storm season now carries not just the fear of physical destruction, but also the expectation of an even bigger bill afterward. An unsustainable trajectory that underscores how climate change is now directly hitting pocketbooks through skyrocketing insurance costs. Rents skyrocket in tech hub, San Francisco leads explosive rebound. San Francisco's rental market is making a jaw-dropping comeback, with rents in the tech capital soaring at a pace that far outstrips the rest of the nation, raising eyebrows about a resurgence of housing demand in the Bay Area. After a period of decline during the pandemic when remote work emptied out many city apartments, the latest data show a dramatic reversal. Average rents in San Francisco have jumped by over 20% in the last year, a surge driven by a new wave of affluent renters, often tied to the booming artificial intelligence and tech sectors, flooding back into the city. This 22% year-over-year rent spike in San Francisco is by far the largest among major U.S. cities and has propelled typical monthly rents in the city to stratospheric levels once again, approaching or exceeding their pre-2020 peaks and reaffirming San Francisco's status as one of the most expensive rental markets in the world. Landlords in desirable city neighborhoods are reporting intense competition for available units, with some prospective tenants even offering to pay several months of rent up front or bid above the asking rent to secure a home. A throwback to the fierce pre-pandemic rental bidding wars that hardly seemed imaginable during the city's mid-pandemic exodus. Local housing advocates express concern that this rent rebound, fueled by newly minted wealth and hiring in the latest tech boom, is deepening economic divides. Longtime residents and lower-income workers are being priced out or pushed to the margins once again, while luxury apartments fill up quickly with higher-income newcomers eager for urban living as return-to-office policies and new job opportunities draw people into the city. The skyrocketing rents in San Francisco are not mirrored uniformly across the country, reflecting a highly uneven rental landscape where some markets are cooling even as others run hot. On a national scale, rental costs have actually shown signs of moderation or even slight declines in certain metropolitan areas. For instance, median asking rents across the 50 largest U.S. metro regions have edged lower compared to a year ago, marking one of the first sustained nationwide rent dips in recent memory. This broad cooling in many markets is largely due to a combination of increased apartment construction, boosting supply in places like suburban Sunbelt cities and tenants reaching the limits of what they can pay, which has forced landlords in some locales to hold the line on rents or even offer discounts. However, cities like San Francisco stand out in stark contrast. The Bay Area's unique confluence of limited housing stock, zoning constraints, and a sudden influx of high-paid workers in emerging industries like AI is now pushing rents back up at breakneck speed after their pandemic slump. Other tech-centric markets are also seeing renewed rent growth, though none as extreme as San Francisco's. Cities such as Seattle and parts of New York have reported rent increases in the mid to high single digits year over year, indicating that urban desirability combined with tech sector recovery is rekindling demand. The divergence between markets underscores a key theme of the current real estate moment. Housing outcomes are increasingly local, with the narrative of falling or rising rents hinging heavily on specific regional economic fortunes and housing supply dynamics. With San Francisco's rent resurgence making headlines, attention is turning to what might come next for tenants and housing policy in the region. The rapid rent climb has revived calls from tenant advocates for stronger protections and relief measures. They fear a repeat of the pre-pandemic affordability crisis, when many working-class residents were effectively forced out of the city. Some have proposed expanding rent control or providing new rental assistance for vulnerable populations as temporary measures. But such ideas face stiff opposition from landlords who argue that artificially capping rents could deter much-needed investment in housing. City officials and economists are also analyzing whether the surge is a short-term spike due to a post-pandemic catch-up or if it marks a longer-term trend that will worsen the affordability gap. The answer may depend on the tech sector's trajectory, the pace of new housing development, and broader economic conditions such as remote work policies. In the short term, frustrated renters are looking for creative ways to manage ballooning costs. Some are downsizing to smaller units or sharing apartments, hoping to weather the storm, while others are expanding their home searches to slightly less pricey Bay Area locales or even considering a move to more affordable regions if flexible work arrangements allow it. Meanwhile, a new crop of tech wealth and high salaries in fields like AI is clearly willing to pay a premium to live in the city, hinting that the demand for urban life in San Francisco, at least among those who can afford it, remains strong. Whether the rent surge continues or eventually levels off, the situation is yet another dramatic chapter in San Francisco's roller coaster housing saga, illustrating how quickly conditions can flip and reminding everyone that the city's housing challenges are far from resolved. In contrast to the explosive rent growth seen in San Francisco, many other parts of the country are experiencing a far more subdued rental environment or even slight relief for tenants. Some Midwestern and Sunbelt cities, for example, have benefited from robust new construction that has added thousands of apartment units, which in turn has kept rent increases modest or flat. Renters in those locations are finding they have more bargaining power than a year ago, with landlords more willing to negotiate or advertise move-in specials to fill vacancies. Data from the spring rental market confirm this dichotomy. While San Francisco's median two-bedroom rent shot back above $4,500 a month amid frenzied competition, the median rent in cities like Phoenix or Austin has leveled off or dipped slightly as a wave of new buildings come online and as an earlier pandemic-driven migration boom cools. This divergence in rental trends, soaring in a few high-cost, job-rich enclaves, steady or softening in many others, speaks to the uneven recovery in city populations and the outsized influence of local job markets on housing demand. For renters nationwide, it means their fortunes now vary dramatically by zip code. Some are catching a breather after years of relentless hikes, whereas others, particularly in revived coastal tech hubs, are once again confronted with eye-popping lease renewal offers and the urgent question of how to afford to keep a roof over their heads in the face of a resurgent urban rental frenzy. In any case, local conditions and economic factors are dictating very different experiences for tenants across regions. The contrast underscores how housing affordability challenges can range from easing in some places to intensifying in others. Shocking bidding war. Netflix effect, home sells for $500,000 over ask. A seemingly ordinary New Jersey house recently sold for an extraordinary price, shocking local observers and reviving memories of the red-hot pandemic housing frenzy as it closed for roughly $500,000 above its asking price after an intense bidding war. Real estate agents have dubbed it the Netflix effect because the home is located near a site where Netflix is expanding its operations in New Jersey, fueling speculation about future property value booms in the area and attracting a flood of interest from buyers even in an otherwise cooling market. The property, initially listed around the seven-figure range, drew dozens of showings and multiple offers within days, culminating in a sale price nearly 50% higher than what the sellers had asked. A jaw-dropping premium that stunned even seasoned market veterans and made headlines as an outlier in today's environment of more measured buyer behavior. Neighbors and online commenters marveled at the outcome and debated its significance. Was it a one-off case of an overly eager buyer with deep pockets aiming to secure a prime location ahead of a big corporate influx? Or does it signal that pockets of the housing market can still become frenzied battlegrounds under the right conditions? The story, which quickly went viral on social media, underscored how, despite higher interest rates and a general cooling from the wild market of 2021, extraordinarily low inventory and unique demand drivers can still ignite bidding wars that send prices skyrocketing for certain highly coveted homes. While extreme, the New Jersey bidding war is not an isolated incident, and it highlights a broader reality that some segments of the housing market remain fiercely competitive. Even as overall home sales have slowed and buyers have regained some leverage in many parts of the country, desirable suburban family homes in good school districts or properties in the path of new economic development can still draw multiple offers and escalate well beyond asking prices. Many regions continue to face chronic housing shortages, particularly for move-in ready, moderately priced properties, which means that when a standout listing hits the market, pent-up demand can erupt into the sort of bidding contests thought to be largely left behind after the boom. Realtors from various states report that while they might not see dozens of offers like during the height of the pandemic market, it's still common to get a handful of strong bids on attractive listings, often pushing final sale prices above listing, especially if sellers price conservatively to start. In some tech and entertainment hubs beyond New Jersey, similar phenomena have been observed. For example, parts of Southern California and Georgia have experienced a studio effect, where the expansion of film production facilities has put pressure on local neighborhoods, with expectations of new jobs prompting speculative home buying and occasional bidding frenzies. The fact that these episodes are still occurring in 2026, despite a very different interest rate backdrop, goes to show that real estate remains intensely local and event-driven, and that the overall moderation of the national market doesn't preclude flashpoints of exuberance where conditions align. The recent sale tied to the Netflix effect has also spurred conversations about housing expectations and the psychology of buyers who fear missing out. For some in the industry, it's a reminder that buyer sentiment can quickly shift from cautious to aggressive when a sense of urgency enters the equation, such as a belief that prices will soon surge due to a major employer moving in or a neighborhood about to become the next hotspot. This mindset, akin to the fear of missing out, FOMO, that drove much of the 2021 buying mania, can still grip portions of the market and lead to what seem like irrational outcomes, even in a higher rate environment. Onlookers have cautioned that paying so drastically above asking could backfire if broader market conditions don't improve as expected, potentially leaving winning bidders with a home that appraises lower than the purchase price, or that could be hard to resell at a profit in the near future. However, for now, the sellers of that New Jersey home are celebrating an unexpected windfall, and their success story is being cited by agents as evidence that strategic home marketing and timing can still produce blockbuster results. Whether these kinds of bidding war tales become more common or remain rare curiosities will depend largely on housing supply improvements and interest rate directions in coming months. But they undeniably add a jolt of drama to an otherwise calmer housing narrative. Even in the current more balanced market, pockets of intense competition and dramatic over-asking sales like the so-called Netflix effect house remind everyone that supply-demand imbalances persist. In communities with very limited inventory, real estate agents say buyers remain willing to fight hard when a well-priced, well-located home comes on the scene. Some are employing tactics like buyer love letters to sellers or offering leasebacks and other sweeteners to edge out rivals in close bidding situations. Housing economists note that national measures of home price growth have flattened, but at the local level, about a third of homes in certain high-demand areas are still selling above list price, indicating that competitive pressures are very much alive where the housing stock is scarce relative to the number of eager buyers. As mortgage rates stabilized somewhat from their peaks earlier in the year, some sideline buyers appeared ready to re-engage, if only for the rare gem of a listing that meets their needs, which can quickly rekindle small-scale bidding wars after months of slower activity. The New Jersey case is an extreme outlier, yet it captures the imagination of both buyers and sellers, the former wondering if they need to up their game even in 2020 SIXS market to secure a home, and the latter daring to hope their property might fetch a similarly sensational premium if lightning strikes. For most homeowners, any sale above asking remains a welcome surprise rather than an expectation. And yet, these instances serve as a reminder that strategic preparation can still yield extraordinary results even in a cooler market. Relocation regret goes viral. Families move to Texas sparks backlash. A personal story of a family's cross-country move has ignited into a viral sensation and a flashpoint for debate on the costs and culture of relocation. A California family's decision to uproot and move to Texas in search of a lower cost of living took an unexpected turn when they publicly expressed deep regrets about the move, prompting an avalanche of online responses from Texans and others across the nation. The family had been drawn to Texas by the promise of more affordable housing, lower taxes, and perhaps a new adventure away from California's high prices and dense cities. However, not long after their relocation, they told a reporter that the reality hadn't lived up to their expectations, citing challenges adjusting to the different climate, culture, and lifestyles in their new Texas community. When their story was published online and shared widely, it struck a chord and a nerve. Some readers, especially Texans, fired back with a mix of defensiveness and schadenfreude, telling the family they should have done their homework and empathizing little with their disappointment, while others around the country saw the tale as a cautionary example of the grass not always being greener on the other side. For many, the challenge of relocating extends beyond financial calculations to the intangible factors of community and belonging, which can be hard to measure before a move. This viral episode highlights what many Americans have been experiencing on a broader scale: the profound lifestyle shifts and emotional complexities that come with relocating from one part of the country to another, particularly in the wake of the pandemic's Great Migration wave. Over the past several years, states like Texas, Florida, and others in the Sun Belt saw a significant influx of new residents leaving higher-cost coastal states such as California and New York, driven by remote work flexibility, a search for bigger homes or different lifestyles, and the lure of more bang for their buck. Numerous transplanted families found success and happiness in their new locales, but there is a lesser-told side of the story involving those who struggled to adapt or found that lower housing costs came with other trade-offs, whether it be extreme weather, fewer amenities, cultural differences, or distance from extended family and friends. Psychologists note that moving to a new state can involve a period of intense adjustment and even culture shock. Seemingly simple differences, from the way schools operate to social norms and political climates, can make newcomers feel like fish out of water even when materially they are better off. In the case of the California family, their frank admission of disappointment resonated with others who harbor private doubts about their own relocations, while simultaneously stoking pushback from longtime locals who often bristle at the narrative of newcomers casting negative judgments on their adopted state. The public reaction to this family story underscores the emotional investment people have in their home states and the tensions underlying America's domestic migration trends. Texas residents, for instance, have grown accustomed to seeing high-profile companies and thousands of people move in from California, and local sentiments have been mixed. Some welcome the economic growth, while others worry about changes to their way of life or rising home prices as demand surges. So when a departing California family's regrets were spotlighted, it became a lightning rod. Some Texas commentators took it as validation that their state isn't for everyone, using the opportunity to emphasize pride in their local values and suggest that anyone who doesn't love Texas should think twice before coming. Conversely, other voices empathized with the family's plight, pointing out that moving is often much harder than it looks and praising their courage to speak up about their struggles. Beyond the internet squabbles, policymakers and city leaders in fast-growing regions like Texas are closely watching how well newcomers integrate, because sustained population inflows bring both tremendous economic opportunities and challenges, such as strain on infrastructure or housing markets. This viral story, dramatic as it is, ultimately sheds light on the personal side of the demographic shifts shaping the nation. The decisions behind relocation are rarely just about numbers on a spreadsheet, but about deeply felt notions of home, identity, and belonging. The phenomenon of relocation regret and second thoughts is becoming a recognized trend as Americans who moved during the pandemic era settle into their new lives. Surveys have indicated that a non-trivial share of those who moved long distances in search of cheaper housing or a change of scenery now question the move, especially as some factors that spurred their decisions, like fully remote jobs or temporarily low house prices, evolve or fade. Real estate experts note anecdotally that a small but notable subset of these movers have even decided to move back to their original states or to yet another new state after discovering that the fit wasn't right indeed. Some coastal markets are seeing a trickle of returnees who initially left for more affordable pastures, but yearn to return when opportunities allowed. It's also worth noting that the dramatic shifts in cost of living that draw people in, such as cheaper homes in the South, can sometimes be offset by other rising costs, like higher insurance premiums, utility bills, or property taxes, leaving some transplants feeling they didn't save as much as anticipated. In the broader context, as the dust settles on the great reshuffle of populations, America may be entering a phase of rebalancing, where people fine-tune their living situations in search of the right mix of economic and personal factors. The tale of one family's surprise dissatisfaction may ultimately be just one thread in a larger tapestry of migration stories that collectively inform how we understand the evolving map of American life. For many who moved, their experiences, good or bad, are shaping others' decisions and perceptions about relocating. Big money buys, ski resort sold, mega mansion up for grabs. The luxury end of the real estate market is making waves with high-profile deals and maneuvers, even as the broader housing market cools, illustrating how deep-pocketed investors and billionaires continue to reshape the landscape with eye-catching acquisitions. In one of the latest blockbuster deals, global investment firm Sixth Street has acquired the Park Hyatt Beaver Creek Resort and Spa, a sprawling 193-room ski resort in Colorado, in a transaction valued at a reported $176 million, marking a major bet on the enduring demand for high-end vacation destinations. The seller, a publicly traded hotel investment trust that had owned the resort, disclosed earlier it had reached an agreement to offload the property and has now confirmed the buyer. Industry analysts see this move as part of a broader trend in which large investment funds are snapping up luxury hospitality assets, anticipating that affluent travelers will continue to prioritize upscale leisure experiences even in uncertain economic times. The Beaver Creek deal is notable not just for its size, but for what it signals. Even with rising interest rates making debt more expensive, well-capitalized buyers are pursuing trophy properties and assuming they can weather short-term turbulence in exchange for long-term gains, a sign of confidence in the resilience of the uppermost tier of the real estate market. High-end investors view unique assets like luxury resorts as resilient investments that can outlast market fluctuations. Meanwhile, on the residential front, one of America's richest individuals is opting for an unusual sales strategy after struggling to find a buyer the traditional way. Billionaire Bill Koch has decided to send his lavish Aspen, Colorado, estate to auction after it languished on the market without attracting a taker at its initial nine-figure price tag. Koch's 52-acre Aspen property, which had at one point been listed for around $125 million, will now be auctioned with a starting ask reported at about $99 million, highlighting the challenge even ultra-luxury sellers face in a market that has cooled and become more price-sensitive. Real estate professionals point out that the very top of the market is incredibly thin in terms of buyer pool. There are only so many billionaires or ultra-wealthy individuals seeking a massive mountain compound at any given time. And so even slight shifts in economic sentiment or stock market performance can greatly slow the sale of such trophy properties. By choosing an auction, Koch is essentially testing a different approach to create a competitive bidding environment and enforce a timeline, something that could either spur a sale near the desired price if multiple billionaires covet the estate, or result in a more modest outcome if the appetite isn't there. Regardless, the story of a multi-million-dollar property going to auction is a reminder that, even at the high end, sellers are having to adapt and get creative to match the realities of the moment. In other headline-grabbing developments, major real estate deals and evaluations in key urban centers emphasize that the top-tier market is alive and kicking. In New York City, for instance, a newly refinanced residential skyscraper on the famed Billionaires Row, an elite stretch of ultra-luxury towers in Manhattan, has been valued at a staggering $600 million in its latest financing round, reflecting sustained confidence by lenders and investors in the enduring allure of prime Manhattan real estate. Similarly, international buyers are continuing to park substantial wealth in marquee properties. One of Nigeria's wealthiest businessmen made news by purchasing a mansion in London for an eye-watering £53 million, indicating that global capital flows into prestigious real estate remain robust. Additionally, whispers of a potential mega-merger between two of the United States' largest apartment landlords have been circulating, a sign that the institutional side of the real estate market is moving towards consolidation. If such a merger were to occur, it would create a behemoth in the multifamily sector and indicate that big players see opportunity in scaling up during a time of transition. These big money moves, from resorts changing hands to high-value refinancings and corporate maneuvers, underscore that while everyday homebuyers may be pulling back, the world of luxury and institutional real estate is forging ahead with confidence and strategic positioning. Downtown doldrums and dreams, Bold Vision aims to revive emptiest city center. In Denver, a bold and imaginative plan is taking shape to breathe new life into what some have called America's emptiest downtown, illustrating how urban leaders and developers are experimenting with unorthodox ideas to revive city centers hollowed out by remote work and changing economic tides. One prominent developer in the Mile High City has rolled out a utopian vision to remake downtown Denver's core with ambitious projects and community-focused design, aiming to transform underused office buildings and deserted streets into vibrant mixed-use spaces that mix affordable housing, green parks, cultural attractions, and tech incubators. This plan comes as downtown Denver has struggled with high office vacancy rates and reduced foot traffic, similar to many U.S. cities, but particularly acute here, leading to a cascade of closed businesses and a palpable sense of drift in an area that once thrived on daily commuters. The proposed blueprint involves reimagining several city blocks with pedestrian promenades, incentives for residential conversions in old commercial towers, and even large-scale art installations to attract people back, while still in conceptual stages. It has garnered attention as a potential model for how to counteract the after-effects of the pandemic and keep downtowns relevant in an era when working from home has become commonplace. City officials have cautiously welcomed the discussion, noting that no single silver bullet exists for downtown revitalization, but expressing hope that large-scale thinking could spark a turnaround and lure not just workers, but also full-time residents and visitors back to the heart of the city. Denver's situation is far from unique, and across the country various cities are grappling with similar downtown doldrums, exploring numerous strategies to adapt to a new normal. In San Francisco, Chicago, New York, and other major urban centers, the narrative in recent months has been dominated by the challenges of vacant office buildings, shuttered shops, and reduced transit ridership. Consequences of a world where many companies have embraced hybrid or fully remote work models. Some cities are offering incentives to companies that bring employees back to the office or to events that draw people downtown even on weekends, while others are focusing on converting commercial buildings into residential units to create more 24/7 neighborhoods instead of 9 to 5 business districts. These downtowns, once bustling with office workers on weekdays, have sometimes felt like ghost towns, particularly in mid-sized cities that lack a strong residential base in their urban core. The stakes are high. A diminished downtown means a smaller tax base for city services and can erode the city's cultural vitality and safety, so the pressure is on local leaders to innovate. Projects like Denver's utopian vision might seem far-fetched to some critics, who worry about the feasibility and cost. But supporters argue that extraordinary circumstances call for extraordinary thinking, and that successful execution, even of a portion of these ideas, could set a precedent for how cities pivot in this post-pandemic era. Interestingly, one sign of adaptation in the commercial real estate sector is the consolidation it's experiencing, as players recalibrate strategies in light of these downtown changes. As part of this reshuffling, the apartment rental sector recently saw news of a potential mega-merger between two large landlords, a move that observers interpret as an effort to gain scale and efficiency in a tough market. The consolidation hints that major real estate investors anticipate a long-term shift in where and how Americans live and work. If offices remain underutilized, there may be a broader rebalancing towards residential uses and a need for deeper pockets to undertake expensive conversions or offering new amenities to attract tenants. In fact, in places like Manhattan and Calgary, a few pioneering conversions of older office skyscrapers into apartments or mixed-use complexes are underway or completed, though the process is often expensive and complex due to structural and zoning issues. City governments are considering tax breaks or zoning changes to encourage more of these transformations, recognizing they could be part of the solution to both downtown vacancy and housing shortage problems. The discussion around bold plans like the one in Denver, combined with concrete steps such as these emerging conversions and business mergers, indicates that the narrative of American cities is still being written, and that necessity is driving innovation in how urban cores might evolve to meet the needs of the future. A wave of office-to-residential conversion efforts is sweeping across many cities as urban areas look for ways to repurpose vacant commercial properties into much-needed housing and more lively downtown districts. From New York to Chicago to San Francisco, developers are investigating whether aging office towers or sprawling corporate campuses can be transformed into apartments or mixed-use spaces, with local governments often dangling incentives or streamlined approvals to encourage such adaptive reuse projects. The appeal is obvious. Cities face twin problems of underused downtown buildings and acute housing shortages, so converting offices into residences could, in theory, help solve both issues at once by bringing new residents and energy to moribund business corridors. Yet, as promising as the concept sounds, experts caution that only a fraction of offices are easily convertible to housing. Many modern skyscrapers have floor plates too deep to allow natural light into potential apartments, and retrofitting them can be prohibitively costly. Some high-profile conversion projects are moving ahead nonetheless, like the plan to turn San Francisco's iconic but half-empty Westfield Mall into a mixed-use center, including housing, or smaller-scale efforts in Boston and Washington, D.C., where underoccupied federal or corporate buildings are being eyed for apartments. Despite the technical and financial hurdles, the momentum behind these conversions is growing, and the success or failure of early projects will be closely watched as a barometer of whether American downtowns can pivot and thrive by embracing new and more diverse uses in a post-pandemic world. Tax showdown: New York targets Paideia Terra, Florida slashes levies. Differing visions for how to address housing affordability and taxation are emerging starkly in New York and Florida, highlighting a tale of two divergent policy approaches to real estate challenges. In New York, after years of debate, a new so-called Paideia Terra tax is set to take effect in the coming weeks, a surcharge on expensive second homes in New York City aimed at tapping revenue from wealthy non-resident property owners. Starting in July, owners of high-value luxury apartments or townhouses that are not primary residences will face an additional annual tax bill that scales upward with the home's value, an effort by city and state policymakers to raise funds, potentially for public housing or transit improvements, and discourage speculative purchases that leave units empty for most of the year. The long-debated measure, now ready for implementation, has drawn cheers from housing advocates who argue it's a fair way to force global investors and ultra-rich second homeowners to contribute more to the city's coffers. But it likewise has sparked fears among real estate developers and the luxury market that it could dampen demand in Manhattan's glitzy condo sector, possibly driving some investors away or lowering property values at the top end. Regardless of its impact, the Paideia Terra tax's rollout marks one of the more aggressive steps New York has taken to leverage its real estate market for public benefit, and the city will be closely watching to see how compliance, revenue, and market dynamics play out in coming months. In a stark contrast down south, Florida is pursuing a virtually opposite strategy, significantly cutting taxes on homeowners in a bid to bolster affordability and appeal to residents. The state's governor has embarked on a legislative push to dramatically expand the homestead exemption, a provision that shields a portion of a primary home's value from property taxes, to an unprecedented $250,000 for most Floridians, effectively eliminating property taxes on a large share of the typical home's value. If enacted, this move would provide sweeping property tax relief to many homeowners, amounting in some cases to thousands of dollars in savings per year, representing one of the boldest tax cut proposals in Florida's history. Supporters argue that with surging insurance premiums and high inflation, homeowners need a break, and such a measure would entice more people to stay in or move to Florida, further fueling the state's growth. Critics, however, warn that this deep tax cut could blow a hole in local government budgets, as property taxes are a major source of funding for schools and services. They fear cities and counties would be left scrambling to either cut services or find alternative revenue. The Florida plan is still winding through the legislative process, but its mere introduction underscores the state's political inclination to use its healthy budget and booming real estate base as tools to cement a low-tax, homeowner-friendly environment, even as other states like New York head in the opposite direction by asking property owners to pay more. What's happening in New York and Florida reflects the broader national debate on how to handle housing woes and government funding and the extent to which real estate wealth should be tapped or nurtured. New York's Paideia Terra tax is a targeted approach that zeroes in on a narrow segment of ultra-luxury properties often owned by non-locals. Officials there insist that average homeowners will not be affected, and they emphasize the moral argument that those benefiting from the city's reputation and services without actually living there ought to contribute more. Florida's sweeping exemption hike, conversely, focuses on everyday primary homeowners and aims to give them a direct financial benefit, with backers frequently touting how it could help seniors on fixed incomes or young families struggling with rising costs remain in their homes. Both approaches carry risks. New York's could deter some investment and slightly soften the top of its real estate market, while Florida's could strain public resources or shift burdens onto other taxes or fees down the line. As these policy paths diverge, they also illustrate how deeply local context and political philosophy shape housing strategies. What's hailed as relief and fairness in one state might be unthinkable or labeled as a giveaway in another. Observers nationwide will be monitoring the outcomes. If New York's tax fills coffers without tanking its luxury market, it could embolden similar initiatives elsewhere. If Florida's tax relief passes and spurs continued growth, without tipping into fiscal trouble, it could reinforce a model for low-tax states. Both scenarios, unfolding in tandem, epitomize the complex balancing act policymakers face in leveraging or easing the immense financial weight that housing carries for individuals and governments alike. On the national stage, lawmakers at the federal level have also been active, signaling that housing challenges are being taken seriously across the board. The U.S. House of Representatives recently passed a comprehensive housing affordability bill aimed at boosting home construction and expanding assistance programs, reflecting a growing recognition in Washington that the housing crisis is a nationwide issue requiring federal support. This legislation proposes measures such as incentives for local governments to relax restrictive zoning laws, funding to promote affordable housing development, and expanded tax credits for first-time homebuyers to help them overcome down payment hurdles. The bill faces uncertain prospects in the Senate, where partisan divides over spending could stall or reshape it, but the very fact of its passage in one chamber shows that housing affordability has risen on the political agenda. This national approach, complemented by the varied strategies in states like New York and Florida, illustrates the multi-pronged efforts underway to tackle a set of problems: high housing costs, limited supply, and homeowner burdens that have persisted and even worsened in many places amid the tumult of the past few years. As housing becomes a pressing issue across different levels of government, consistency and collaboration in solutions could be key to effecting change. These top-down and bottom-up strategies all contribute to a broader push to improve affordability and availability of housing nationwide. K-shaped housing reality, boom in some segments, bust fears in others. The latest housing data and expert commentary point to a K-shaped dynamic in the real estate economy, where some segments of the market are thriving or stabilizing, even as others struggle or decline, painting a complex picture of winners and losers in the current cycle. On one side of the K, demand remains solid in sectors like new home construction and the high-end market. Homebuilders have been buoyed by limited inventory of existing homes for sale and continue to see interest from buyers who are frustrated by the resale market scarcity, especially as builders offer incentives like mortgage rate buydowns to make new homes more attainable. High earners and investors, relatively less sensitive to interest rate hikes, are still active in purchasing properties, which has kept luxury home prices resilient and even rising in some exclusive areas, and allowed deals like multi-million-dollar residences and prime commercial property investments to proceed without much slowdown. On the other side, however, segments like entry-level housing and certain overheated pandemic boomtowns are facing headwinds. First-time buyers are notably constrained by high mortgage rates and steeper credit standards, sidelining many and causing sales in the starter home category to droop. Similarly, a number of mid-priced housing markets that saw frenzied price spikes in 2021 to 2022 are now stagnating or seeing slight price declines, as local incomes can't support those peaks and the pool of remote work relocators shrinks. Examples include some Mountain West cities and parts of the Southeast that soared during the pandemic and have since cooled. For every market still seeing robust demand, there is another experiencing a slowdown, reflecting an uneven landscape unlike past cycles. Analysts like Alan Ratner of Zelman & Associates have been vocal about this K-shaped economy in housing, a term borrowed from macroeconomics to describe a recovery that benefits certain groups far more than others. Ratner and others point out that high mortgage rates have effectively created a huge discrepancy in outcomes. Households that already own homes with locked-in low interest rates have gained significant equity and are sitting tight, while those trying to enter the market now face a completely different world of elevated costs. This dynamic means that homeowners in established, higher-end neighborhoods are generally seeing their property values hold steady or even increase slightly due to scarce supply, one prong of the K trending upward. While younger or less affluent would-be buyers find themselves stuck renting and watching their homeownership dreams slip further out of reach, the downward prong of the K. Geographic divergence is also pronounced. While prices in many Midwest and Northeast markets remain stable or are still inching up, some of the once hottest areas like Boise, Idaho, or Austin, Texas have plateaued and are susceptible to downturns if economic conditions worsen, fueling cautionary talk of localized bubbles that could deflate more. This fragmentation of the market into divergent paths is a notable departure from the more synchronized booms or busts of past housing cycles, and it suggests that broad generalizations about the housing market can be misleading. The reality is more nuanced, with some submarkets in a boomlet even as others are in a slump at the very same time. The housing narrative is thus split and highly context-dependent. The global perspective offers its own warning signs about the tales of the K-shaped trend, as illustrated by cautionary tales abroad. One eye-opening example making international headlines is New Zealand's housing market, which experienced an extreme housing bubble through the early 2020s and is now going through a painful correction that observers around the world are watching closely. After years of skyrocketing prices that made New Zealand's homes some of the most unaffordable relative to local incomes, the bubble began to burst recently under the pressure of higher interest rates and stricter lending rules. Home prices there have been falling significantly from their peak, leaving some recent buyers underwater on their mortgages and raising concerns about broader economic repercussions. This boom and bust storyline in New Zealand is being held up as a cautionary example for other countries or cities that saw similarly vertiginous run-ups in home values, a reminder that what goes up too fast can indeed come down, especially once cheap money and speculative fervor fade. In the United States, economists are debating whether certain regions might face a New Zealand-style outcome if mortgage rates stay high and a recession hits. While nationally, a 2008-like crash is not expected due to much stronger lending standards and housing undersupply, there is a consensus that some frothy markets could see double-digit declines. Such international comparisons underscore why rising risks in real estate have become a buzzword. As segments of the market diverge, there's an increased focus on identifying which ones may be vulnerable to a reversal and which have enduring strength. Shadows of the K-shaped housing market extend beyond just prices and sales volumes. They're affecting real people's lives differently depending on their position in this split landscape. For example, homeowners who locked in 3% mortgage rates 2 years ago not only enjoy lower monthly payments, but are also benefiting from continued year-over-year home equity growth in many areas, boosting their net worth and giving them financial flexibility. Conversely, renters and aspiring homeowners face rising rents and an inability to buy due to double-whammy high prices and borrowing costs, exacerbating wealth inequality between those who own property and those who don't. The K-shape is likewise visible in rental markets, where demand for luxury apartments and single-family home rentals has stayed robust, supported by higher-income households and institutional investors. While more affordable rental stock sees extremely tight supply and potential tenants stretching to cover rising rents or staying put in suboptimal arrangements. Policy experts suggest that bridging these divergent outcomes should be a key priority, from expanding down payment assistance and low-rate mortgages for first-time buyers, to zoning reforms that encourage more construction of entry-level homes and apartments. The aim would be to flatten the K so more Americans share in the benefits of a stabilized, eventually growing housing market. For now, though, the phrase K-shaped housing recovery has taken hold to describe a reality where prosperity in real estate is very uneven, and where careful navigation is required to avoid the potential pitfalls that can arise on the downward side of the curve. Analysts agree that mindful policy and strategic planning are needed to ensure the benefits of recovery are spread more equitably. Real estate outlook and hopes. Buyers adapt as market awaits a breakthrough. As the real estate market recalibrates to a new normal of higher interest rates and moderate activity, many prospective homebuyers are adapting their strategies and bracing for the long haul, with a mix of weariness and cautious hope defining the overall mood. A sense of frustration has set in for a segment of would-be buyers who spent the last couple of years waiting in vain for mortgage rates to retreat significantly. With rates stubbornly hovering in the 6% to 7% range and no immediate signs of a dramatic fall, some of these buyers are giving up on the idea of a near-term return to cheap money and are instead recalculating what they can afford, or whether they should pause their home search indefinitely. This sentiment is reflected in a recent consumer survey indicating that a sizable share of potential homebuyers have lost confidence that interest rates will drop soon and, as a result, either plan to delay buying or adjust to the reality of higher monthly payments if they do proceed. The psychological shift is significant. After years of ultra-low rates, the expectations of many Americans had to reset, and that adjustment is now playing out in slower sales and tempered attitudes, yet it's not all doom and gloom. As a dedicated cohort, still out house hunting are finding creative ways to make it work amid the challenges. For remaining buyers, perseverance and creativity are key to navigating the market's new constraints. One outcome of this environment is that resourceful buyers and sellers are engaging in new tactics to bridge the affordability gap and clinch deals. There's a rise in seller concessions, for example, where sellers might agree to cover closing costs or even subsidize a temporary mortgage rate buy-down to entice buyers who are balking at the cost. Buyers, for their part, are increasingly exploring options like adjustable-rate mortgages, ARMs, with lower initial rates, co-buying with friends or family to pool resources, or targeting smaller homes and fixer-uppers that come with a lower sticker price. Others are expanding their geographic horizons, considering homes farther from cities or in different states where prices and taxes are lower. The flexibility of remote work has made such trade-offs more feasible for some. For instance, a young couple determined to buy their first home might skip out on expensive coastal markets and instead purchase in a Midwestern city where their budget stretches further, a pragmatic shift that is contributing to population and housing demand growth in some of these more affordable regions. These adaptations are evidence of Americans' resilience and the strong desire for homeownership that persists even when conditions are less than ideal, and they're playing a crucial role in keeping the housing market from seizing up entirely. Looking ahead, a cautious optimism is creeping into the narrative as economists and housing experts outline scenarios for the market over the next year or two. While the current interest rate environment remains a hurdle, the consensus among many forecasts is that mortgage rates will gradually ease down if inflation continues to cool and the Federal Reserve eventually pivots to a more accommodative policy. Some major housing prognosticators are expecting the 30-year fixed rate to dip closer to the low 6% or even high 5% range by late 2026, which, though not a return to the ultra-low rates of the early 2020s, would mark a notable improvement that could draw more buyers back into the fray. On the home price front, national values have shown a remarkable resilience, largely flat or gently rising in many areas thanks to limited supply. A few overheated markets have seen corrections, but a broad crash has not materialized and is not anticipated absent a severe recession. This stability is giving some potential buyers hope that any purchases now won't be immediately followed by plunging values. Though affordability remains stretched, it's not being compounded by a fear of instant negative equity as it was in 2008. Homebuilders, sensing pent-up demand, have recently grown slightly more confident as well, reporting a light uptick in foot traffic at model homes when mortgage rates ticked down briefly in spring. All these signals suggest that while the path forward is not easy, there is a potential pathway to a healthier housing market, albeit one that might take time to unfold and likely requires a bit of good fortune in the broader economy. Finally, various stakeholders are increasingly recognizing that solving housing challenges will require concerted action and creativity, adding another layer of guarded hope. Policymakers at local, state, and federal levels are floating proposals from first-time buyer savings programs to zoning overhauls aimed at boosting housing supply, although turning these ideas into reality can be slow and politically fraught. Community organizations and businesses are also stepping into the gap. Some larger employers have started offering home buying assistance as a perk to attract and retain talent. And public-private partnerships in certain cities are focusing on converting unused properties into affordable housing stock. These efforts, small and large, all contribute to a sense that even if the market is tough now, it is not being ignored and that solutions are being sought to make real estate more accessible and sustainable. Ultimately, the year 2026 finds the real estate sector at an inflection point, tempered by high costs, but not defeated, filled with individuals adjusting to the new normal and organizations trying to pave the way for better days ahead. The collective hope is that through incremental progress in interest rates, innovative strategies by industry players, and supportive policies, the market will gradually find firmer footing, enabling more people to achieve their housing goals as this cycle turns. For many in the field, collaboration and adaptability are the watchwords that will define the path out of the current challenges. Video tags,